Module Overview. This module explores the various methods and valuation approaches used by property valuers to determine the worth of real estate assets. A correct understanding and application of valuation methods are the backbone of sound, defendable property appraisals. The approach selected depends on the type of property, the purpose of the valuation, available data, legal and physical characteristics, and the highest and best use of the asset. One overview of valuation approaches. There are three universally accepted traditional valuation approaches, plus hybrid or modern techniques that may combine aspects of all three. These are the comparative, sales comparison, approach the investment, income capitalization, approach the cost, contractors, approach residual, profits, and DRC methods, specialized or hybrid methods. 2. The comparative approach, sales comparison method. Definition. This method determines the value of a property by comparing it with similar properties, comparables, recently sold in the open market. Procedure. Collect data on similar, recently sold properties, adjust for differences, e.g., size, location, age, condition, tenure, amenities. Derive a unit rate, per square meter, per room, per plot, etc. Apply adjusted rate to the subject property, best used for owner-occupied residential properties, vacant land properties in active markets with abundant comparable sales data. Strengths. Reflects current market activity, transparent and easy to understand. Limitations. Difficult in inactive or rural markets. Adjustment process is subjective and requires deep expertise. 3. The investment, income capitalization approach. Definition. Used to value income-generating properties by converting expected net income into a capital value using a capitalization rate. Types. Direct capitalization. Uses a single year's income and a cap rate. Discounted cash flow, DCF. Projects multi-year income and discounts to present value. Key inputs. Gross income, operating expenses. Net operating income, NOI. Capitalization rate, based on market expectations or risk. Profile, formula, direct capitalization. Value equals NOI divided by capitalization rate, best used. 4. Office buildings, shopping malls, rental apartments, hotels and leisure properties, industrial warehouses with tenants. Strengths. Forward-looking, reflects income-generating capacity, suitable for investors and financiers. Limitations. Requires reliable income and expense data. Selecting cap rates is complex and often subjective. 4. The cost. Contractors approach. Definition. Estimates value based on the cost to rebuild the property minus depreciation plus land value. Steps. Estimate replacement or reproduction cost. Deduct depreciation, physical, functional, and economic. Add land value, determined separately, often by comparison. Best used. For new or specialized properties with few comparables, public or institutional buildings, e.g. schools, police stations, insurance valuation strengths. Reliable for unique or non-market assets. Useful when income or comparables are unavailable. Limitations. Land value can be hard to isolate. Depreciation estimates can be subjective. Ignores market behavior and buyer perception. 5. Residual method of valuation. Used primarily for development sites, it estimates the value of land or buildings by deducting all development costs and desired profit from the anticipated sale value of the completed development. Formula. Residual value equals gross development value minus open parenthesis. Construction cost plus fees plus contingency plus profit. Close parenthesis / text. Residual value equals text. Gross development value minus in text plus construction cost plus in text fees plus in text contingency plus in text profit. Requires accurate development cost projections, current market sale values, regulatory approval assumptions, very sensitive to input errors, used by developers and in feasibility studies. 6. Profits method of valuation. Used for businesses where the value is tied to the business's profit, like hotels, petrol stations, cinemas. Hospitals. Valuation is based on value equals adjusted net profit times multiplier open parenthesis, yield close parenthesis, 7 depreciated replacement cost, DRC method. A variant of the cost approach used for assets that rarely or never sell on the open market, such as power stations, public facilities, government properties. 8. Choosing the appropriate valuation approach. Valuers must analyze nature of the property, availability and reliability of data, market conditions, intended use of valuation, sale, tax, insurance, mortgage, litigation. A triangulation of methods, reconciliation, is often encouraged to produce a more reliable value estimate. 9. Adjustments and weighting. Where multiple comparables or methods are used, apply weightings based on reliability, adjust for time, location, amenities, condition, lease terms, etc. The valuer's professional judgment is critical to balance analytical accuracy with market realism. 10. International Valuation Standards, IVS, and Method Harmonization. This section introduces global valuation standards, e.g., IVS, RICS Red Book, and how valuation methods must be transparent, be reproducible, comply with global ethical standards,